Hey guys, we got exciting guests as usual. So Casey, thank you for coming.
Hey, how's it going?
Casey is professional. He is doing the tax burden. He's going to help you guys to understand what you actually liable and what you guys paying. I don't know, monthly or yearly. If you earn the change we want you to make, if you earn $5 million or $10 million, right? And a lot of times professional athletes, they do not understand what they actually paying, and then that's where the Casey steps up and he's professional in the tax liabilities. Casey, thank you for coming on the show.
Yeah, thanks for having me. Yeah, so we're going to go over a few different things. Generally speaking, you need to know how much you're paying in order to, as a step one, to figure out, is it worth the time, the energy, the hassle to fix it, or are you okay with that amount? So if you're making, let's say, $10 million a year as a professional athlete, in California, you're probably paying 40% tax, give or take. So that's $4 million a year in taxes that you'll be paying. That's a lot of money. We want to show you ways and strategies and structures so you can significantly reduce that tax bill. So that's what we're digging into today.
That's beautiful. Casey, just to understand, again, people do not understand what they pay. Most likely the team was holding from them, right, the huge amounts.
Yeah, there's different ways to look at this. So from a W-2 perspective, there'll be an amount that the team withholds for taxes, for contributions. And it's a small sliding scale, but you can ask them to hold more of that or less of that. But the first thing you should do is speak to your agents, your business managers, or the team directly, HR, and get what that taxable number is, because you've got to be aware of how big the problem is before you go and solve it.
Why do you think athletes find out too late what they're paying?
It's a fast life, right? So if you're an athlete, you're in the fast lane, there's a million things going on all at once, whether it's on the field or whether it's personal or with a million different things, right? So it's easy to lose track of things, but to have the right team around you, they should be guiding you, they should be keeping you aware of what that is and what that looks like. And then if they're doing a really good job, more importantly, how to significantly reduce that tax burden too.
If you earn 10 million bucks, you have a manager, right? And maybe a team behind you. Do you think, Casey, manager understands what are the taxes and what's the liabilities comes?
Well, the manager's got a tough job, right? They've got to manage the whole system, and there's a lot of moving pieces. So it's tough. The manager's not a CPA, it's not an accountant. And even when you do get a CPA and accountant, that person isn't working fully for you, right? This is a common misconception that the CPA's job is to reduce your taxes. It's not. The CPA's job is to make sure he calculates your taxes and that he files and that you pay. As long as that happens, he's happy. Generally speaking, most people pay their CPA a set amount. So regardless of if he's saving you 1 million or 10,000, he's getting paid the same. The only real way to get someone working on your tax savings is with a tax strategist, because a tax strategist is incentivized to save you money because they take a small piece of those savings that they find. So you've got to incentivize the right person and have the right person on your team. A tax strategist is different than a CPA.
Essentially, the professional athlete is just the highest, like not highest, but the high paying employee,
Correct.
right? On
Yeah.
W-2. What do you think the examples of common mistakes they probably making on taxation side?
So we can boil it down into two main things, right? So if you're an athlete, generally speaking, you should have a private foundation. That would save you instantly 30% a year on your tax bill and still be able to control those funds. And then the second thing you should do is have a limited partnership with a nonprofit, and that will allow you to take your endorsement money and save 50% on taxes on that. So, as a range, you're going to save anywhere between 30 and 50%, depending on the type of income and depending on the structure you use. So this is not using low-level loopholes that kind of don't really apply to a multi-7, multi-8 figure entrepreneur. So structures is what helps those people. So the more money you make, you grow out of loopholes and you grow into structure. So it's even more important to make sure you have a really solid foundation and the right structures in place to be able to save anywhere from 30 to 50% a year on your taxes. So if you're paying, let's say, $4 million a year in taxes, that could be a $2 million saving just like that with one correct structure. So it's a big deal.
That's huge. Yeah, thank you. So again, we're talking about the legal ways to save on taxes, right? And there's two parts you touched, right? One is you have to have some type of LLC, right? Partnership.
Private foundation.
Private foundation.
Is the first one.
The second one.
It's a limited partnership.
Limited partnership. So with those two, you can do a lot of different things, correct?
Yeah, correct.
So the next question is, what they don't understand, right? So you can write off a lot of things once you have that structure.
Well, you can write off a lot of things as you are. They just have to be business related. So on the personal side, when you're a W-2, there's not really much you can do. Private foundation's pretty much the most powerful tool. We've also seen some athletes collecting their paychecks in Bitcoin rather than US dollars. And those athletes have kind of increased their wealth tremendously because Bitcoin's gone through the roof. It is a riskier strategy, but if you are all in on crypto and you believe in it, that's a type of strategy you could do. And then the other side of it is on the endorsement side, don't have that come to you personally. Make sure that's going into an LLC, a limited partnership, just a type of company, so that you can then run a lot of business deductions through that entity. Because if you take it personally, you're done. You're going to waste a lot more money on taxes.
That's huge, right? That's a huge piece. Okay, and then the question is here, right? Once let's say you accept, right, half of your salary in Bitcoin, right? And time comes, it's 5 years over. You're going to be paying like a huge capital gains, right, as well. If you're not inside of the private foundation.
Yeah, or inside the limited partnership, yeah.
Or let's say we're making like example of you put that chunk of money, right, chunk of Bitcoin, let's put it this way, and then it grew. If you put money, so most likely diminish, right?
It's definitely diminishing in cash, yeah.
Yeah, that's another huge piece. But then if you put it in Bitcoin, right, and then all of a sudden after 5 years you want to withdraw something, and then now you just need to pay like capital gain on it. If you put it inside of the structure of the private foundation, that's different. What is that? Can you tell us?
So firstly, our clients don't pay any capital gains tax, right? Because we know how to structure it. We wouldn't do it like that, because if you left it in that example, you took the Bitcoin as payment, you didn't do anything with it, it grew, and you cashed it out, it's going to be a huge capital gain. So you can say bye-bye to a third of whatever you've achieved, right?
Yeah.
Third of your growth. Why would you want to give that away? So there's ways and techniques, and what we would say is either donate it to the foundation, there's no capital gains in the foundation, or donate it to the limited partnership. And again, it grows tax-free and you pay less than 1% tax rate on any growth.
Yeah, and whatever you just saved on taxes, you can reinvest into something else, right?
This is where you go from being rich to being wealthy.
Yeah.
So that transition of now my money is making money for me. I don't have to perform as an athlete. I don't have to make sure I get my next contract. My money is growing at a rate that I can live the lifestyle I want and not have to perform on a weekend.
Yeah, and that's how you expand your life immediately.
That's
right?
ultimately the key difference between being rich and being wealthy.
Okay, so the point is, because I'm going through my son, right, and then different teams and stuff, now I start to see a lot of like, okay, Paul George, elite team, which is, I never seen Paul George in that thing. But then we got Paul Pierce, right, was the truth team. I feel like that means they got private foundation, right? Because those are like high earners. They get 50 million a year, right, or so. And then I feel like they do have a private foundation structure, and then they push that team through that private foundation. And it's not just for fun, not because they want to just get the team. It's also probably the tax strategy, right? Can you tap into that thing?
Yeah, everyone does it a little differently. So when you have a foundation, it splits into two sections. So you can have a public foundation and you can have a private foundation. If you have a public foundation, then you are actively seeking donations from anyone. If you have a private foundation, you are not seeking donations from anyone. It's just a small family or just a handful of people that are going to donate into that. So that's the main difference. When you look at corporations dressed as nonprofits, NFL is a huge nonprofit, right? So there's a great example of what we think or know this makes hundreds of millions of dollars every single year, but it's still classed as a non-profit. Another one that surprises most people is Rolex is a non-profit. Now you can have the best or one of the best watch companies in the world, and technically it's a non-profit.
It's insane.
So yes, there's a lot of things happening behind the scenes in terms of advantages being taken by having the right type of structures. And again, it depends on what outcome it is that you're trying to achieve. So if you're doing a basketball league in your local community, chances are you want to develop that local community, right?
Yeah.
So there is a lot of good that has been doing there too, but it's been done in an efficient way where you're getting a tax deduction for that too. So why not have the best of both worlds where you get to do good in your community, give something back to the kids, and save a whole load of money on taxes.
Money on that.
Yeah.
I feel like, and again, correct me if I'm wrong. So this is the like, you not passively waiting for, you know, what's going to be withheld from you. You aggressively, right? And you proactively actually thinking about that. And if you like, let's say 10 million plus contract, now the question is how you can save, which is probably going to be like, it's going to equal to your salary, right? If you can save 40, 30, I don't know, 50% of your taxes.
Yeah, it's a big deal. Like if you're making, let's just say 10 million a year, you're paying 4 million in taxes, and then you can save 30% or 50% by having the right structure. That's like adding
another salary.
Yeah, that's like adding another 4 or 5 million in salary just because you're more efficient. So there's being proactive and being reactive. It's like being offensive versus defensive, right? So when you put that analogy in, is you've already worked so hard to get where you are. Why let the water out the bucket because you haven't tightened a few screws, right? You've got to stop that leaking, and taxes is a easy way to stop the hurt so that you can, one, build your own legacy and build that for your future kids, future community, whatever that is, in your own name. So that's why you see a lot of players and a lot of companies having a huge nonprofit arm.
It's like another way to put it together. So you getting paid to play offense, right, on the field. So I don't know, you NBA, NFL, MLB. But then when it comes back to your taxes, like you playing defense all the time, right? So
always. Everyone's complaining come tax time. Hey, my tax bill's too much. What can we do? Last minute. You can't do anything last minute. You've got to proactively plan that out. You've got to get the right entities. Well, first, you got to get the right team, right? So again, back to step one, you got to know how much you're paying. You got to really want to fix that problem. Then you've got to hire the right team. You need a tax strategist on your team, in your ear, working with your team, right? You don't have to replace your business manager or your CPA or whatever. You can bring in a tax strategist to oversee that department and say, hey, your job is to find what these guys are missing because I know there's something better out there, but I just don't have the team or the time to go fix it. I need you to do it. And if you're only paying them based on what they save you, what have you got to lose? It's just up and up, right?
That's huge, yeah. That's huge. That's a big change, I think. So the question, again, that probably a lot of people asking themselves, what's a legitimate charitable expense? Because people, I feel like, may be confused with that. Can you tell us? Because it's the same business kind of idea.
Yeah, so this varies. There's a lot of gray areas in this one, right? So it varies from business to business. So as an example, we've got many clients that have jets and yachts. Now, our justification for that is this is for business purposes. This jet gets me from A to B quicker so I can close a deal, whether it's real estate, whether it's relationship, whether it's recording a podcast, whatever it is, it's for a business activity. And the same with the yacht, right? We're entertaining clients. We're going to get X amount of new clients by taking them out on having a yacht party. So as long as you have a justified reason, and you can back that up too, right? So you can't just take the family on the jet and go off to Mexico every weekend, right?
Yeah.
You can, but that should then be classed as personal, not as business. So you got to keep really good records. You've got to really know what is business and what is personal. And then if there is an overlap, split it accordingly. We're going to save you so much money on the structure level that you don't have to worry about nickel and diming at the loophole level.
Yeah. That's a good point. That's a really good point. Okay. repeatedly I heard from LeBron James, he spends millions of dollars. I think in 2020 it was a million. Now it's probably like three, four
Yeah,
on the recovery,
yeah, longevity. Yeah,
right? Because and again, so it's not different for non-LeBron James, whatever. So what do you think? Is it legitimate expense for the guys who like working their tail off every single day, right? And they want
100%.
to
Because
recover.
his business is his body. So if his body is in such good shape, it can last longer.
Yeah.
And he can get another contract. Then all of those millions of dollars he's invested is well worth it, right? So if he's making how much a year? What, 50 million, 100 million? How much does LeBron make a year?
I don't know. It's a lot.
Tens of millions, right?
Yeah.
So if he can spend 2 million a year and get a $10 million a year contract at the end of it for a few more years, that's a great ROI. So his hyperbaric chamber, his energy biochargers, like all of these things, stem cells, all these things that the athletes do, peptides to kind of enhance their body and their longevity is all part of the business, right? Because their body is the business, which is hard because they're an artist. They have to perform. So if you can perform longer, you're going to get paid more. That's a legitimate write-off for sure.
Yeah, that's a write-off right away. So it's not even.
But if he wasn't a superstar or a professional athlete and he was just a regular business owner like you and I,
Yeah.
it's going to be tough to justify, hey, I've got a hyperbaric chamber. I go in it
Every day.
Yeah, I'm gonna work longer. That's not quite gonna work for you, all right.
Yeah.
But if you're a professional athlete, it's more relevant to your business, and that's the key part, right? With a yacht and a jet and a car or a truck, you can justify that for pretty much most businesses. But with a specific thing like a hyperbaric chamber, which costs what, 50 grand, 100 grand,
Yeah.
then that serves a specific purpose for longevity.
No, that's huge though. So can you give us, again, let's go from the, green thing so we can change, but then to the red flags. Like what's the IRS like completely hates to see right on the books, or then what's going to be the red flag immediately? What do
Any
you think?
big changes? So if you go, let's just say you go from $5 million a year to zero. We saw this in COVID, right? A lot of businesses went under.
Yeah.
That's a drastic change, and it would be like, okay, what happened here? Did you close? Did you just lose your business?
Yeah.
Or if it goes the other way, right? If it goes from 5 million to 50 million, okay, what happened here? Are you paying your fair share? Because if the percentage has changed on the bottom line, that's what they're looking at. And they have these new AI algorithms now.
Oh, wow.
So they're not as far back as everyone thinks they are. Even though their budgets are getting cut and their workers are getting cut, they've replaced a lot of that with AI. So now it can analyze numbers a hell of a lot quicker than humans can, right? So you can get flagged on things. So keep away from drastic changes if you can, and just don't push the needle too far, right? It's like you're much better off having a better structure and doing less of the gray loopholes, because a structure is black and white. We know with certainty you can donate and get a 50% deduction or a 30% deduction. It's written clearly in the code. So if you ever have to defend that position, it's really easy. Whereas if you've got a car and you use it for personal use and for business use, they're like, okay, now I have to justify every mile, every bit of gas I put in there, the maintenance becomes a lot of a headache. And if they don't like it and they're like, okay, you've overdone it, then they start digging deeper. So is it really worth it? Don't go after the pennies, go after the pounds.
Yeah, that's a really good one. So a question is here. So I'm a professional athlete. I'm making like $20 million again. So
You doubled your salary already just in this time of this podcast.
Yeah.
Done well.
And then we got, let's say we got IRS. I got private foundation right set up, and then we got IRS. Like, do you expect to be audited? So how often would they audit that specific vehicle, right, and structure?
Good question. So foundations are audited a lot less than LLCs, believe it or not. And it's because you have to fully document all of your financials. So when you submit a tax return for a foundation, whether it's public or private, it's public information. So you now, listening to this podcast, can Google Bill and Melinda Gates Foundation, and it'll come up and you can find their tax return for that foundation. You can see every penny that they've spent on employment, on expenses, on projects. It's all listed there. So the theory is, because it's listed in the public domain, the IRS doesn't need to audit it as much because there's so many people out there looking at it that would self-audit it if there was anything crazy going on.
Wow. But it's for public. So
Both public
both.
and private are public information.
Any private foundation will be the same way.
Correct.
I just go out and Google, it should be like available.
Yeah, you can get a PDF of their latest tax return.
Okay, wow. So like any nonprofit is supposed to have that.
Yeah, so it's fully transparent, right? So again, with that level of transparency, you can say, hey, Bill and Melinda Gates Foundation has got $5 billion in it. Their top executives all make over $1 million each. They donated to these.
Is that real numbers right now?
Yeah. They make over $1 million each, a lot of their executives.
For the foundation, right, executives?
Yeah.
Wow.
On the board, yeah.
That's a good salary.
It shows you every grant, every scholarship, all their expenses as well, and then grouped together. So it's not like super granular.
Yeah.
But it's all listed there. So the chances of fraud happen, we know a lot of fraud happens within nonprofits anyway, but the chances of it happening are a lot less than in an LLC.
Gotcha.
S Corp or a C Corp.
Because it's just a private, right? It's closed.
Because you've got to disclose it. There's so many people looking at this. And the same way the IRS has algorithms, there's companies like ProPublica that publish everyone's financials.
Okay.
And they then review them as well. So if there's any huge anomalies, you'll start getting a hit piece on your foundation if you're not doing things right.
Yeah. So we're talking about Melinda and Bill Gates Foundation. So if you look at them, do they make money as well? Do they invest
a lot of money? Yeah.
Through that foundation?
Yeah. So foundation can also have a trading account. So let's just say you got $5 million in your foundation. You can have a Schwab trading account or whichever platform that you invest with, right? And that plugs into the cash and it grows tax-free.
Tax-free, nothing.
Yeah,
right?
so you don't pay any tax on any capital gains. And then there is something called net investment income, which is 1.4% tax rate.
Wow. So that's the only thing you pay inside of the foundation.
Correct.
Right?
Yeah.
That's all. Okay. So basically, if you talk about them specifically, Microsoft, right? So they got two purposes. One, they can grow inside of that foundation, their wealth, right?
Yep.
And then the second one, they can support all the charitable initiatives, whatever they want to do, right?
Yeah, and ultimately at the $1 billion level and like the family office level, they have multiple entities. It's not just one entity, right?
Yeah.
So they'll have a public foundation, they'll have a private foundation, they'll have limited partnerships, and they may have a multiple of the same type of entity, right? Because everyone can trace the Bill and Melinda Gates Foundation back to them very easily. But they might have other foundations in other people's names that they're doing other things with.
Yeah.
So it becomes a spider web of activity that you can then use and create real wealth with.
So what are you saying most likely, right, on this Microsoft example, right? It's
Bill
gonna
Gates
be
example.
Bill Gates, example. So that's going to be probably just the one, maybe small entity, right? And then they
But it's huge. It's billions of dollars in it.
Saying,
yeah.
And then they probably have multiple, maybe private things, right? And LLCs
Yeah,
and partnerships and
100%.
stuff.
It's all linked together.
Yeah, but then to the public, they showing that face kind of, right?
Correct, yeah.
Okay, that's a really good point. I think I got a couple like rapid questions for you, right?
Okay.
My agent handle my taxes. So what can I do? Like, what's going to be the starter?
So you got to ask the agent, how much are you paying in tax? What is the percentage? How can you reduce it? Because the agent isn't incentivized to reduce your taxes the same way the CPA isn't incentivized to reduce your taxes. You're the one who's really incentivized to save it, but you're too busy doing life, doing business, right, to actually deal with it. So hire the right person, a tax strategist that can come in, and their whole job is to reduce that tax bill.
Yeah, just the regular mistakes are maybe a myth, right, about the things. And I ask you again, so I want to ask you that question. So I can write off everything.
No, you can't write off everything.
Right?
No.
It
Absolutely not. No. You can write off anything that's related to a business activity.
Yeah.
So as an example, if a hyperbaric chamber is going to help your business, then yes, you can write that off. Or a car or a yacht or a jet, yes. But if it's not related to your business, you can't write it off.
It was a beautiful watch. It's very important for my business.
Great example. Okay, so beautiful watch. If you are in front of a camera, a TV personality, and that is part of your appearance, then there's a justification for that watch.
So it's real.
Yeah, because you're going to wear it in photo shoots, in the studio recording. You can justify that.
Wow. Okay. That's cool. I didn't know that.
Again, you're pushing the boundaries, but if it's real, then it's doable.
NFL guys, no, MLB, let's put MLB. They like to get the chains, and we talk about that on the podcast. Like, I bought a new chain. Can you justify that? And I show up at the game with that chain.
No. How's that going to help your business? It's not. Unless you've got a fashion business, then maybe at a push you could do that and say, hey, this is part of my fashion business and I have to look fashionable, so I have to buy these chains and watches and teeth and diamond earrings so that it fits for the fashion business.
Yeah, if
that's real, who knows?
I'm gonna hit that nail because I got the doctor I'm following all the time. He's doing all the NFL guys and this diamond teeth.
Donnelly, is it Dr. Donnelly? Yeah, I know him. Yeah.
Yeah, is it possible? So you can justify that and write off this brand new. No way, right?
How can you justify that as a business expense? I would never allow that for my clients.
Okay, so that's a good one. So
But let me give you a little secret sauce, right? You can do a loan, right? So when you talk about deductions, that's what most business owners would default go to, right?
Yeah.
And that's a lot of gray area in that. But if you've got a limited partnership and there's cash in there, so to see Dr. Donnelly is 150,000 as a range to get your teeth done, right? You can issue a loan from the limited partnership to yourself for, let's just say, 150K.
Yeah.
A loan is not income. You don't pay tax on it. You can set fair terms at market rate.
Yeah.
And you can pay that back over whatever duration is feasible, right?
Yeah.
So now you've got the 150,000 in your back pocket, go get your teeth. But you're doing it based on debt rather than income. So you're switching it from the profit and loss to the balance sheet.
Yeah.
So it's non-taxable if it's a loan. So again, this type of strategy is the difference between having a CPA or a business manager that are not experts in how this world works versus a tax strategist that would say, hey, don't put it through your business because you're going to get a red flag, you're going to get an audit, and you're getting in trouble.
Yeah.
But if you flow the money to the limited partnership and you issue a loan, which is all, if done properly, is all perfectly fine, that's how you can maximize the efficiency of that transaction. And you can go buy a chain, teeth, rings, diamonds, watches, whatever you want, but you're doing it the right way.
Good. So next huge question again, because of those guys, they take in more and more, right? Crypto and NFTs don't get taxed.
They do get taxed. Of course they do. Any asset gets taxed, right? So if the crypto right now, it's over $100,000. If in a year's time, it's $200,000, there's a gain there. So unless it's in a tax-exempt entity, a private foundation, or if it's in a limited partnership that's owned by a nonprofit, it's tax exempt. So again, it's back to the way you structure things rather than if you just held it in your wallet in crypto from day one and didn't move it, you'd have a huge tax bill versus if you structure it the way we recommended it and just talked about, you'd be saving anywhere from 30 to 50%.
Good. And then I feel like it's the last one of the last ones. I only owe tax where I live.
False.
Sometimes you see they got different teams, for example, right? Let's take a professional guys and then they just, employed here. The house was there, they just moved and stuff like that. How's that all works then?
So America's terrible for taxation, right? There's a global tax on you if you're an American citizen. So it doesn't matter if you live here, live there, live anywhere, the American government will come tax you.
Wow.
So you've got to be really careful of, one, knowing that, and then having multiple streams of income. So whether it's just from your team, from your endorsements, from overseas endorsements, all of that gets taxed unless it's structured in the right way. Like if you structure it correctly, you can significantly reduce a lot of it. But again, it's all about team, right? I don't know how many times we can say it in different ways, but if you don't have the right team, and the team that's got you from where you are to from where you started to where you are now isn't the same team that's going to get you from here to where you want to be in the future. You've got to always be improving and upgrading your team the same way you're improving your body and your mindset and mentality, right? You've got to always be improving. So make sure that you do that with your team as well.
Absolutely, that's a huge one. And I think we're gonna just finish up with a simple thing. There's 3 moves every athlete should make now to protect their and keep their money. So what do you think?
Okay. Hire a tax strategist, number 1. Open a private foundation, number 2. And get a limited partnership, number 3. Do those 3 things, you'll save minimum 30% up to 50% every single year. We're talking 7 figures a year there.
And the lastly, so where's the best place to reach KC, right?
All right, yeah, you can reach me at togethercfo.com, YouTube, Instagram, website, pretty much anywhere. Just type that in and we'll come up.
Yeah, again, KC is professional on the tax strategy. If you guys need help, right, if there's a pain, always reach out to Together CFO. He'll be able to help you, right? And you're not going to regret it for the rest of your life, though.
Yeah, we'll do a free consultation for you, show you exactly how much you've overpaid, but then more importantly, give you a plan on how to stop that overpayment so you can put that money back in your own pocket rather than Uncle Sam.
Thank you guys for sticking with us, right? And I'll see you in the next one.
Thanks for having me. Take care.
Good. Awesome. Beautiful.